Hi, Dennis. How are you?
Hi, Constance. Good to see you. Good to talk
Yeah,
to you.
no,
Okay,
thank
I'm
you for
good.
taking the time for this Tight 10 series. Given your background as the investment committee member for the Ford Family Foundation and the 19 years that you've spent at Cambridge Associates as an investment consultant and allocator, we are wondering in terms of given what happened in March with the COVID-19 pandemic and the US economy shutdown, and how portfolios have since done and recovered. Some have, such as the stock market, as we have seen. What would be your main concerns and sort of the things that we should watch out for as an allocator and investor?
Oh, wow. Just going back as we were living through this March 2020, the memories of 2008 were very vivid. And then I thought I had seen it pretty much the most severe market I could have. But going through this was factors beyond imagination. Luckily, though, we have remembered the lessons learned from that. And there, it's again, we have a diversified portfolio, and it's diversified, and in the individual parts will behave differently during this type of market stress at different degrees. And so you pull out the playbook and you say, well, what didn't I do back then? I should absolutely do right now. And we've learned a lot since then. We watched the industry evolve. We saw hedge funds sort of come and then lose a lot of its effectiveness, at least the long short funds. But then on the other types of funds, hopefully they have kept their defensive nature and posture. The bonds have kept their uh, their utility during market stress downturn, and so the playbook suggests, and we followed to absolutely redeem and to sell the bonds, especially when the 10-year hit 0.5%. I mean, that was just a neon signal. So back in March, I'm on the investment committee. We called an inter meeting, or whatever you want to call it, interim type of gathering, and we discussed, and then we acted. And so it's very important not just to discuss, but to act. And it's in the teeth of the storm, and we act, and then we act with staggered type of execution. So again, sell the bonds, and then what do we buy? We buy beta. We buy S&P, we buy Nasdaq. If you want to get even more refined, which was the absolute correct thing to do, since the new economy stocks seem to be doing much better since they're not sort of under the virus stress, COVID stress. And then we also look for opportunities. And what type of opportunities? I guess, the whole thing, the whole situation brought back memories of distress. And so there's a instinctive reaction to allocate toward distress, because what will come, not sure, hopefully it doesn't become, prolonged distress, but clearly some industries have been dislocated. Retail, airlines, travel, hospitality, entertainment, energy industry. And so there were, among all the recommendations, there was some even bolder ones to go buy real assets, because I think we were very close, if not after the first Fed action of the trillion plus type of intervention, and we didn't know how many more would come first. But again, back in 2008 style, and much more rapid now. The rapid intervention basically meant devaluation of the currency. So when you devalue the currency, the only thing you do is go reach for hard assets that retain value. So yeah, it is now playing out. I guess we're here now, almost at the end of May, and it looks like a lot of those mechanisms were correct.
So I think
But
I think in the distress opportunity space that you had just talked about and the various sectors, how would or could an allocator or an investor take advantage of that? In terms of maybe the type of managers they could pick, and maybe from your experience, the type of managers that investors should avoid and the ones that investors should look for. And what sort of qualities do you think, is important when an investor allocates to a hedge fund or a credit fund or a real asset private equity fund?
um, and I was an allocator at Cambridge, first as a generalist and then as a specialist for hedge funds. And so managed many portfolios of hedge funds. Now, portfolios of hedge funds basically follow the same rule. They have an overall mandate and objective, get you a decent return, but at much less volatility cost. And so with that, you have to diversify within there. So you should have many of the components, absolute return, non-correlated, low beta type of funds with a mix of, say, maybe higher beta, more directional funds. And together they will get you a return that can meet your endowment foundation spending requirement of 5% a year at much less volatility costs. But then again, it cannot hope to, keep up with, just long only beta indices or long only beta concentrated managers. With that said, there are tools within the portfolio that you should accentuate, especially in a downturn, in a rapid downturn where you anticipate rapid dislocation afterwards. And so, there your event arbitrage or whatnot, managers that have a very strong distress capability. They usually have also distress focused funds. Granted, you don't know when they come in vogue. So if you keep an allocation to them constantly, you're going to have this sort of a tax or an opportunity cost as they don't perform because there's no distress, and there hasn't been distress since, like, say, '08. Yeah. But now we've got one, big as, up to wazoo now. So those managers have, focused funds. And so, we just take a phone call that manager up. He's good enough to allocate for his diversified fund. And, you should have a very good distress capability. And so that's what was done. Those, and what do I look for in managers? Okay, now this one made the cut, obviously, since, we can make a call and we have to, move very rapidly. They really don't have much time to go look for new ones out there and have them go through the vetting process. So ideally, you have enough of diversification and talent pool within what you have. But ideally, you look for managers that there's no huge secret sauce here. It's just common sense. Basically, when you invest with somebody, you're becoming a partner, not just a third party, arm's length removed, even though you're not really having any sense, say in the investment decisions, but you're becoming a partner. And as a partner, you're gonna say, well, who do you want to be a partner with? People that are gonna be transparent with you, they're gonna be honest with you, they're not afraid to break bad news, they're not afraid to tell you bad news. That in peacetime, so to speak, they're very forthcoming and honest. And when the wartime comes, they should continue to be very upfront and honest. No one expects people to be perfect, but you expect them to be honest. That's basically what I use. I go in there and you ask simple questions, and if it takes a long time for them to answer, that's not the kind of people you want to be around, because you don't need to spin on just truth. And basically the truth.
Right. So really transparency, right? Transparency, not just in good times, but bad times even more so.
Yeah, transparency. Well, transparent. I mean, they can't tell you, every trade they do, and really how much value is that? But it's like, if they lose money, they should know where they lost it, and they should be very quick to tell you how. And whether that's avoidable or not, it's all, it's, just be honest with what could have been done and what can be done, and what maybe, if they see that situation again, what will they do, or what are they doing to safeguard against that, if there's any safeguard at all. Then you just judge whether they have any common sense, whether they are always looking to improve. That's a very good quality, improvement. People that just stay the same basically will get wiped out by the market eventually. And whether they're humble about their ability, right? Ego and too much self-confidence is basically the seeds for future disaster.
Right.
And I've seen a lot of disaster. And I've seen a lot of success too.
So,
I'm so positive.
So what else are you up to, in addition to, we were talking about a biotech fund that you had recently come up with, really like to hear a bit more about it, and also sort of how you came about with the idea for a biotech fund, and what are you looking at, for that particular niche strategy that you're investing in?
It actually came, I'll take the last part. It actually came about sort of as a function of working for this unique family foundation. They asked for out of the box ideas, and so as part of that, I was the generalist as well as the hedge fund specialist for them. I suggested that we approach U.S. equity different, because that was, I'm not going to buy a U.S. long fund and then a U.S. small cap fund and beat by 20 basis points. That's not really going to be that outstanding or differentiated. Instead, I suggested we go with biotech hedge funds on the long side. mostly predominantly US centric, but they are, very sort of high octane, but I think in a good way. And looking through the first quarter performance and into like year to date, they performed, absolutely magnificently. And it's not like we can look into, say, well, just allocate the biotech hedge funds, you do fine, because some of them will crater you pretty severely. So which ones you pick? So, the manager selection was good. I'll compliment myself again. But they've really held up, and it's the managers, and I guess we had some benefits, and this was sort of biotech related, this type of market stress, but not so much. We didn't have any of the COVID type of biotech companies. These are managers we invested in, but they way outperformed to the upside. So with this, studying them, prior to investing with them, years ago, I noticed the asymmetry in these type of stocks and started, doing them in my own PA account, and now regularly do that in sort of a more formalized setting, structured setting, buying 25, 30 of these names and offsetting again, neutralizing against an index. And it has reduced the volatility of biotechnology to 50 to 40% of what the index is, and and the return has been double. So it's been absolutely fantastic.
Oh, that's awesome.
Yeah, but it took a lot of experience and a lot of false starts along the way. So that was sort of my hobby as I was a consultant.
That's interesting. Yeah, no, thank you for sharing that.
Mm-hmm.
And in this in this sort of environment now with the COVID situation, like how would someone in your position, let's say if you have to see a manager or visit a manager, how would you conduct your due diligence?
I think nothing really can substitute in person, because you want, at least my style was to hit fast reactions, right? Like time, and I evaluate the quality and the talent there. And part of that is how quickly does this synapses fire, to questions, and then to get the intangible body language that's present in a room. You can try to get that. I think you can probably get some of that over the video, but I guess it takes a little getting used to. But right. I guess we do the same thing. Yeah. Hopefully you don't have a big time lag with your VPN or whatever.
Well, thank you so much for your time. I appreciate it.
Sure.
Thank you for sharing experience as an allocator and as an investment consultant.
Thank you. It's been fun.
It is.
Happy
well, stay safe and be healthy.
Okay, thanks.
Okay, bye now.
Bye.